Imagine for a second that you were driving down a busy, like multi-lane highway at 70 miles an hour.
Okay.
You're surrounded by traffic, the weather is shifting and the road is winding. But there is a massive catch to this.
Right.
Your windshield is completely blacked out, and you only get to look at the road for 1 single second every 6 months.
Wow. Yeah, that sounds like a guaranteed disaster, honestly. Because, I mean, the environment around you is changing constantly, but your data is completely static.
It is terrifying to think about. But that is exactly how some of the largest, most powerful systems in the world actually operate.
They really do.
They set a course, they lock it in, and they functionally, close their eyes to new data.
Yeah.
So welcome to the Time and Market Deep Dive. Just a quick reminder right off the top, this discussion is strictly for entertainment purposes, and you should always seek professional advice for your own portfolios. Also, let us know in the comments if there are any other topics you would like us to explore. But today, our mission is to explore a concept that has really defined 2026 so far, which is the speed of adaptation.
Right. The speed of adaptation.
Yeah, like how fast do massive systems, whether we are talking about state governments or, multi-billion-dollar investment funds or even complex mathematical models,
Yeah.
how fast do they need to adapt to actually survive when their environment changes overnight?
Well, the volatility we are seeing this year is stress testing everything. I mean, we are finding out in real time that systems built solely for stability are just dangerously unresponsive when they are forced to adapt.
Yeah, and to really grasp the mechanics of this, I feel like we need to set a baseline first.
Sure.
We need to look at how massive structural institutions handle adaptation over the long term. So we dug into the Washington State Department of Licensing's 2025 to 2027 biennial budget submittal.
Oh, right. Looking at a State Department's budget is honestly a perfect way to visualize institutional friction.
Yeah, it really is.
Because a government agency simply doesn't turn on a dime. They operate on these, 2-year planning cycles.
Yeah, and looking through their submittal, you see the massive structural overhauls they are requesting funding for right now. Like their strategic priorities are things like engaged and prepared employees and equity and inclusion. And under those umbrellas, they are systematically addressing years of accumulated technical debt.
Right, which takes a lot of planning.
Totally.
Oh.
They're also updating external forms with like plain talk principles, adopting a dual language performance model to improve language access, and spending significant capital to modernize their Olympia area facilities to accommodate a permanent hybrid workforce.
And the mechanics of how this works is what is really important here.
Yeah, how so?
By operating on a biennial budget, Washington State is locking in its capital allocation all the way out to 2027.
Wow, 2 whole years.
Yeah. If you are retrofitting a massive physical facility for a hybrid workforce, you have to secure the contractors, sign the leases, and allocate the funds years in advance. You are forced to predict what the working environment will look like, 24 months from now.
Right. And I understand the necessity of it. You can't have a government agency just improvising its structural budget month to month. That would be chaos.
Exactly.
But think about the vulnerability that creates. This biennial budgeting process is kind of like steering a massive cargo ship.
That's a good way to put it.
It takes years of foresight to plot these course corrections. You spin the wheel today, and the physical ship actually starts turning 2 years from now.
Yeah, the delay is built in.
But what happens if a global event fundamentally changes the way we work? Or, say, new technology renders that technical debt project completely obsolete just 6 months after the budget is approved?
Right, you're stuck.
A cargo ship cannot dodge a sudden obstacle.
It highlights a fundamental trade-off of scale, I think. Massive institutions basically must build rigid, predictable frameworks to function without just collapsing under their own weight.
Yeah, they need the structure.
And that rigidity ensures stability during calm waters. However, that required rigidity is the exact mechanism that makes adapting to sudden violent volatility incredibly difficult.
And that 2-year delay makes sense for a government building physical infrastructure. But the terrifying part is that some multi-billion-dollar financial institutions are using that exact same rigid kind of calendar-based planning to navigate the stock market.
Oh, absolutely.
We are seeing this exact cargo ship problem play out right now with a highly rigid momentum fund, specifically Invesco's S&P 500 Momentum ETF. ticker SPMO.
Yeah, SPMO is essentially the Washington State Department of Licensing of the momentum investing world, if you think about it.
That is painfully accurate.
It manages a massive footprint. I mean, around $14 to $15 billion in assets. It has historically been incredibly popular, but early 2026 has really exposed the mechanical flaw in its operating system.
Yeah, the performance gap right now is alarming. I mean, the broader market is undeniably choppy this year. The S&P 500 is down roughly 4% to 6.7%, depending on your exact entry point.
Right.
But SPMO is bleeding even heavier, down somewhere between 5.74% and 7.5% year to date. And what really stands out to me is the valuation. SPMO currently trades at a price-to-earnings ratio of 31.17.
And let's unpack why that multiple matters in this specific context.
Please do.
A PE of 31 is expensive. When you pay a premium multiple for a stock, you are paying for expected future growth and sustained momentum.
Right, you're expecting it to keep flying.
Exactly. But if the momentum suddenly breaks and you are holding a basket of stocks with a PE over 31, you are holding highly vulnerable assets with a very long way to fall.
And SPMO is basically forced to hold them because of its rule book.
Yep.
It operates on this semi-annual schedule. It reconstitutes or completely rebuilds its portfolio only twice a year, in March and September.
It's that cargo ship turning.
Right. And they just executed their scheduled March 2026 reconstitution. And they entirely cleaned house. I mean, They dumped major household names like Meta, Chase, Walmart, Netflix, and Visa.
Which is a huge shift, and we really need to look closely at where they rotated that capital instead.
Oh, yeah. The new allocations are wild.
They leaned heavily into semiconductors and mega cap tech. NVIDIA is now their top holding, taking up over 9.4% of the entire fund.
Wow.
Broadcom is over 8%. They brought in Johnson & Johnson at 4.69%, Micron at 5.89%, and then combined across its share classes, Google makes up over 8% of the fund.
I saw an analogy from a retail investor online, Lisa J. Stocks,
Yeah.
that perfectly frames how people usually use this fund.
Oh, yeah. What'd she say?
She describes building her portfolio like building a house. She uses a broad S&P index as the solid foundation, right?
Makes sense.
And she uses SPMO as the higher risk, high growth satellite edition to capture alpha.
Yeah.
But reading through these allocations and the semi-annual rules, I really struggle with that strategy.
Because of the timing.
Exactly. If SPMO is only rebalancing in March and September, aren't you essentially drafting your fantasy football team in week 1 and then the app locks your roster for half the season?
That's a great analogy.
Like if your star quarterback breaks his leg in week 2, you are mathematically forced to take a 0 at that position for months. You literally can't change it.
And that is precisely the mechanical trap that SPMO is in right now. The algorithm uses a 12-month look back to determine what stocks have momentum.
Okay.
It looks at the past year of data, but crucially, its rules force it to ignore the most recent month.
Wait, it ignores the last 30 days?
Yeah, it drops the last 30 days of price action entirely to avoid short-term reversals.
So they are driving down the highway by looking exclusively in the rearview mirror, and there is a giant blind spot right behind the bumper.
Exactly. So when the market rotates violently and leadership changes overnight, which is exactly the story of early 2026, SPMO gets trapped. If semiconductors suddenly lose momentum in April, SPMO physically cannot sell NVIDIA or Broadcom until September. The algorithm is forced to hold on to stale momentum while the stocks just potentially bleed out.
Okay, so if SPMO is the cargo ship getting caught in a storm because it can't turn the wheel, there is a competitor out there behaving much more like a speedboat. I want to look at the market desk-focused U.S. Momentum ETF, ticker FMTM.
Oh, FMTM. Yeah, FMTM is engineered to exploit the exact vulnerabilities we just identified in SPMO's methodology.
And the performance difference is just striking. While SPMO is sinking this year, FMTM is actually up an impressive 9% to 10% year to date, with its current stock price sitting at exactly $38.08.
It's a huge divergence.
Yeah, and despite outperforming, it is fundamentally cheaper. FMTM has a much lower PE ratio of 25.67 compared to SPMO's 31.17.
And the outperformance really comes down to the mechanics of their trend evaluation.
How so? Like, what's the structural difference?
Well, instead of using a lagging 12-month look back, FMTM evaluates the consistency of a price trend using a much tighter 6-month window.
Okay, so half the time.
Right. And they aren't just looking at the total return either. They evaluate the actual quality of the movement.
What do you mean by quality?
So if a stock jumps 40% in one day on like a news ringer and then trades flat for 5 months, a traditional momentum fund might just buy it based on the math.
Because it's up 40% overall.
Exactly. But FMTM screens for steady, consistent upward pressure. It wants a smooth trend, not a choppy one.
I see. And they also have a different sandbox they play in. They hold 30 to 50 equal-weighted stocks, but they include mid-caps, not just the S&P 500 giants like SPMO does.
Right, which opens up entirely different opportunities.
But the real mechanism that drives their survival rate in 2026 seems to be their speed of adaptation, because FMTM rebalances every single month.
Yep, they can swap out the injured players on their roster in real time, basically.
The risk management data on this structural difference is incredible. Since the FMTM's inception in March of 2025, they experienced a maximum drawdown, which, for those listening, is the amount the fund drops from its peak to its lowest trough of only negative 9.2%.
Which is very manageable.
And they recovered from that drop in just 28 days. Now look at SPMO over that same time. SPMO suffered a negative 15.2% drawdown and took 87 painful days just to break even again.
Think about the psychological impact of those numbers on a daily basis, though.
Oh, it's brutal.
Behavioral finance tells us that every single day a portfolio spends below its prior high is a day an investor is staring at a red screen, basically battling the temptation to capitulate and sell everything.
Yeah. If your money isn't SPMO, you are waking up to losses for basically a quarter of a year. That is 87 days of just doubting your entire strategy.
Exactly.
But with FMTM, 28 days means you barely have time to get your monthly statement in the mail before the fund has adapted, rotated its holdings, and completely recovered the loss.
And that speed of recovery is really the difference between an investor staying disciplined and an investor panic selling at the absolute bottom.
I hear the structural arguments, and they make sense, but I have to push back here for a second. If you look at the investing communities on Reddit right now, specifically our ETFs, they are tearing this debate apart. There is heavy skepticism directed at FMTM.
Oh, I've seen it.
The argument basically goes like this. Sure, FMTM is winning in this specific choppy market, but it is a tiny, unproven fund. It only has around $80 to $100 million in assets under management. SPMO is a $14 to $15 billion behemoth. Furthermore, FMTM charges an expense ratio of 0.45%, whereas SPMO is super cheap, only charging 0.13%. In what world does it make sense to pay triple the management fee for a tiny fund? Isn't this just chasing the flavor of the month?
Well, that skepticism is entirely logical until you understand the physics of market slippage.
Market slippage.
Yeah. There's a massive contradiction in financial markets that retail investors often miss. For a strategy like FMTM's, having a tiny amount of assets is actually an incredible advantage.
I'm struggling to see how having less capital is an advantage on Wall Street. Usually, big money wins.
Let's visualize how market friction actually works in practice. FMTM's algorithm requires them to be incredibly nimble. They are buying equal weights of mid-cap stocks, which have much smaller trading volumes than a massive company like Google or NVIDIA.
Okay.
Because FMTM only manages around $100 million, allocating, say, 2% of their fund to a mid-cap stock means they are only buying $2 million worth of shares.
Which is tiny in the grand scheme of things.
Exactly. They can slip into the market, buy those shares, and slip out without anyone even noticing. The price doesn't budge. Now, imagine SPMO trying to execute that exact same agile, equal-weight mid-cap strategy with $14 or $15 billion.
Okay, I see where this is going. If SPMO allocates 2% of their fund to a mid-cap stock, they have to buy like $300 million worth of shares.
Right. Imagine an elephant trying to step into a crowded elevator without bumping into anyone.
You're going to crush somebody.
It is physically impossible. If SPMO tries to buy $300 million of a thinly traded mid-cap stock, the sheer volume of their purchase orders will just eat up all the available shares and drive the price of the stock through the roof.
They would literally destroy their own momentum trade just by trying to enter the position.
Yes, that is market slippage. A $15 billion fund physically cannot execute an agile monthly rebalancing strategy in smaller stocks. The friction would tear their returns apart.
Wow.
They literally have to stick to mega caps like NVIDIA and Broadcom, and they have to rebalance slowly over months to hide their massive trades. So you are paying that higher 0.45% fee for FMTM specifically because their small size allows them to execute a rapid adaptation strategy that the big institutional funds simply cannot replicate.
That is fascinating. Okay, so we've seen how a quantitative mathematical algorithm that adapts monthly completely dismantles an algorithm that adapts semi-annually. But if speed of adaptation is the key to surviving 2026, what happens when we introduce human adaptability?
Well, human adaptability completely breaks the scale of what we have been discussing, but it comes with a severe cost.
Right, because we pulled the verified leaderboards from the 2026 financial competitions.
Oh, the competition numbers are wild.
They are. These are million-dollar-plus accounts managed by active, human money managers who are constantly reading the market and adapting minute to minute. The numbers they were putting up are staggering.
Unbelievable number.
In the stock division, Jason Speziali was up 42.5% in just 2 months, January and February of 2026. And in the enhanced growth division, Ashwin Raghavan logged a positive 142.3% in January alone, over 140% in a single month.
Yeah, but to achieve that kind of return, a human manager has to utilize massive amounts of leverage and take highly, highly concentrated risks.
So it's not a safe, broad strategy.
No, not at all. They are reading the immediate environment and betting the house on a specific direction.
It is incredible to see, but we have to contrast this human element with the strict, 100% data-driven quantitative math that drives ETFs like FMTM. The entire philosophical foundation of these quantitative funds is to completely eradicate human emotion from the adaptation process.
And the math required to do that effectively is incredibly rigorous.
Yeah, tell me about that.
You don't just write a simple line of code to capture momentum. The foundation of this quantitative logic is actually being built by mathematical societies right now.
Like who?
Well, for example, look at the recent results from the Singapore Mathematical Society's Olympiads and project festivals. Students at the NUS High School of Math and Science are winning gold medals for highly complex projects on vectors and bounding generalized forms.
Okay, stop right there.
Yeah.
How does a mathematical project on vectors actually translate to a financial algorithm managing millions of dollars?
Think about what a vector is in physics. It is a measurement that has both direction and magnitude.
Okay.
In finance, a traditional human investor might look at a stock chart and say, the price is going up. That is just direction.
Right.
A quantitative momentum algorithm uses vector analysis to measure both the direction of the price and the magnitude, meaning the velocity, the consistency, and the sheer force of the buying pressure behind it.
Oh, wow.
Yeah, and the math on bounding generalized forms helps the algorithm draw mathematical borders around chaotic price movements to filter out the noise. It is purely unemotional physics applied to human buying habits.
That is wild. But it makes me really question the sustainability of the human returns we just talked about. Like, I marvel at 140% in a month. But can a human being dealing with fatigue, cognitive bias, and the sheer adrenaline of a levered trade consistently beat an emotionless, mathematically perfected vector algorithm over a decade? It's like comparing a human sprinter to a marathon-running robot.
Exactly. The human manager is required to be right on the exact timing and the exact direction every single time they adapt.
Which is impossible.
If they misread the environment and the market moves against their concentrated leverage, they blow up the entire account in an afternoon. The quantitative algorithms running funds like FMTM are not trying to capture 140% in a month.
They don't need to.
Right. They use that rigorous vector-based math to systematically rotate between offense and defense.
So they adapt every 30 days to provide a smoother ride, protecting the capital during drawdowns so you don't spend 87 days staring at a red screen. They basically win by consistently not losing.
It is the ultimate application of disciplined adaptation versus chaotic reaction.
This brings the entire concept full circle for me. We started by looking at the slow, deliberate 2-year planning cycles of the Washington State Department of Licensing.
The cargo ship.
Right. They're a massive cargo ship that takes years to turn. Then we moved to the clunky, lagging 6-month rebalances of the SPMO Momentum Fund, completely tracked by its own rear-view mirror. And finally, we looked at the agile monthly pivots of the FMTM speedboat, using vector analysis to dodge market drawdowns. Survival in a volatile environment is entirely dictated by your speed of adaptation.
The systems that can digest new data and execute structural changes without friction are the only ones truly thriving in 2026.
Absolutely. And I want you to think about how this applies to your own life. We talk a lot about financial portfolios, but look at your own mindset. How often are you reconstituting your own career strategies or your own assumptions?
That's a great point.
Are you operating on a 6-month delay? Are you holding on to habits or beliefs that stopped working months ago just because your personal rulebook hasn't updated yet?
Auditing your own speed of adaptation is honestly one of the most valuable exercises you can do, especially when the environment around you is shifting daily.
So true. I want to leave you with one final provocative thought to mull over. We spent this deep dive proving that moving from a rigid 6-month rebalance to a nimble 1-month rebalance drastically improved downside protection and boosted returns. It allowed the algorithm to drop dead weight and capture new trends. So logically, What happens over the next 5 years? As advanced mathematics, vector analysis, and artificial intelligence become seamlessly integrated into our markets, we will inevitably see momentum funds that don't wait 30 days. They will rebalance daily or even hourly.
Adapting to new data the exact second it hits the tape.
Will that create the ultimate crash-proof portfolio for you? An algorithm so fast it sidesteps every market drop before human traders even read the headline?
It's possible.
Or will the sheer compounding friction of millions of AI algorithms constantly, violently adapting and buying against each other every single second simply tear the entire financial system apart? If we clear the blacked-out windshield entirely, do we gain perfect vision or do we just shatter the glass?
It is a massive question, and honestly, the market is going to answer it for us very soon.
Thanks for joining us on this deep dive. We'll see you next time.